Hello everybody, Luke Gromen, FFTT. Hope you are well. We are getting into the dog days of August here for the summer in lovely Cleveland, Ohio. It is downright soupy outside, very humid. You're getting into the beginning of football two-a-day practices for high schools out there. So fond memories of those, although I'm not sure I'd want to go back and do them again. I do have fond memories of them. So with that, we're going to jump right in. Thank you, as always, for the questions. Really appreciate it. Very helpful. Really enjoy going through the thought process. So again, thank you. So let's jump right in. First question is from Thomas. Has the Japanese interest rate rise significantly undercut levered yen carry trades, forcing liquidation these past few days? If so, what can we expect over the coming weeks? I am not an expert on the exact structure of the yen carry trade other than the general outlines. With that said, yes, it probably has undercut it to a certain degree, and I would expect probably more volatility in the very short run in terms of next few days, next couple weeks, and then more dollar liquidity from central banks. When we get further beyond that, we take a step back and look at something that is starting to present itself, in my opinion, is a very big problem, I think, for policymakers. And the reason I say that is we're now seeing that if the yen gets too strong, it creates a carry trade unwind in the yen carry trade. We've been harping on that if the dollar gets too strong, we will see an unwind in the dollar carry trade. Remember, that's the $57 trillion gross, $22 trillion net international investment position that foreigners hold in the U.S. against $13 trillion in dollar borrowings and some tens of trillions in eurodollar obligations. So you're into this window where dollar too strong, carry trade unwind, major carry trade unwind. Dollar too weak against the yen, in other words, yen too strong, yen carry trade unwind, which will quickly spill into other effects. And so there's only a certain amount of operating room for policymakers, and that as debt rises in both nations, that operating room is going to shrink. And so my guess is in the short run, there will be applications, tactical applications of liquidity from policymakers trying to buy time. But ultimately, what has really struck me most by this yen carry trade unwind over the last several days, week, is that policymakers globally are on the clock. This is now going to shrink. Too strong a dollar, bad things. Too strong a yen, bad things. What does that mean? That means there's going to have to be some sort of non-linear policy change sometime in the not too distant future. I'm not talking about weeks, maybe not even months, but in the next year, 18 months, 2 years, on current course and track because of these two carry trades, neither of which can abide too strong an underlying currency, you're going to need some sort of non-linear policy, systemic reset, gold revaluation, currency devaluation, big debt buyback, war. I don't know. Massive political change with some sort of significant austerity, something. But it's that to me right now is my biggest takeaway on this. So let's see what happens go forward, both tactically and then more a little bit further out. From Gambati. Hi, Luke. On your latest episode of Shift Matters with Grant Williams last month, Grant compared the seemingly delayed realization of what's really happening to the U.S. and its precarious debt situation with the Monty Python and Holy Grail scene on the marauder running towards the castle, seems to be miles away. For a long time, all of a sudden, he's right there at the doorstep, kills the guard, and goes in. And do you believe experienced market commentators and policymakers believe this, or are they just ignoring the situation the U.S. is in? My strong sense is that Western officials at the senior levels know there is a serious fiscal and debt problem. However, they can't comment on it because it would convey weakness in what is a increasingly delicate, shall we say, domestic political and global geopolitical situation. and time and moment in history. And so it seems to me possible, if not likely, that they are handling the U.S. debt and fiscal situation, both the senior policymakers and commentators closest to them as a result, like Biden's declining faculties of the last 3 years. They're pretending it's not a problem. They're pretending everything's fine. They are dismissing and attacking anyone who says otherwise. And the problem is that, like Father Time to Biden's faculties over the last 3 years, Father Time didn't care. And compounding interest doesn't care. It never sleeps. It keeps compounding as the debt keeps rising. So there's this great article in the Wall Street Journal from about 3 weeks ago talking about how the last time Biden met with the House Democratic Caucus was in October 2021. That the meeting went awfully. He was incoherent. And that was the last time he met with House Democrats in that House Democratic Caucus 3 years ago. They all knew. They all knew then. And yet they all played along until end of June. Now, I don't care about the politics of it really, because what I'm really interested in is how's it going to impact the macro here with the U.S. debt situation. And I think what all of this implies is it sets up a Biden-like situation with the U.S. debt and fiscal situation, which is to say it's going to go from it's fine, it's just a stutter, he's just mumbling, to oh my gosh, he's gone in a compressed period of time, except for the debt this time. I think it'll cause some volatility when that happens, and then it'll be dealt with quickly, likely in an inflationary manner, likely all in a brief period of time, like the Biden situation was. And so there's lots of ways to do this. Most of them aren't that pleasant. Some inflationary, some disruptive, some geopolitical. But the point is that most investors think, well, I have time. The policymakers aren't worried about it yet. They're not even talking about it yet. I have time. Maybe. Or maybe not. Maybe it's going to be dealt. Maybe it's just going to take one bad debate. Oops. He just had one bad debate. The debt just had one bad debate. And we've gone from everything's fine to 4-alarm fire. So I think there's a lot of people going to be as surprised as they were that Biden's faculties were declining about the U.S. debt situation, probably sometime in the next 18 months. So let's see. From Chris, in discussion with Preston, Peter, and Danny on what Bitcoin did, you discussed China has been essentially doing the Bitcoin trade by swapping dollars for hard assets, basically the same sort of thing that Michael Saylor had been doing with Bitcoin. I understand the water issue in China, why they were anti-Bitcoin mining, but why are they actually anti-Bitcoin ownership, Are they perhaps concerned that Bitcoin is a U.S. controlled, whether the Satoshi wallet is controlled by the U.S. still, or et cetera, and that, or even if it's CIA, something like that, and that going Bitcoin would be out of the frying pan into the fire, still under the U.S.'s thumb? Or would they rather stick with gold, some other reason, et cetera? Thank you. I do think initially it was heavily an energy and water issue in terms of China's attempting unsuccessfully to ban Bitcoin and sort of get the miners out of the country. Probably some cultural issues there as well around gold. There's still a lot of gold is still seen extremely favorably. I am hearing from credible sources that the Chinese Communist Party is now giving tacit approval to Bitcoin. And the reason I say that is that apparently you can buy it in China on Chinese government internet apps, which is to say, if you can buy Bitcoin on Chinese government internet apps, the Chinese government knows about it and they're letting you do it, which tells you they're giving you the wink, wink, nod, nod, sort of just don't embarrass me kind of thing. So I heard that in the last few months. I thought that was very interesting. So let's see, in regards to why before, I think it was mostly an energy and water issue. From Andrew, comment on international equities. These seem generally overlooked. Terrible trailing 15-year performance, really terrible in dollars, but better valuations and potentially looking strong in weak dollar scenario. I'm ambivalent, however, as many developed countries' futures look bleak. We had a chart last week in Tree Rings highlighting from, it was a great chart by Top Down Charts, highlighting that non-China EM just broke out of a 17-year chop, which is pretty significant. When you chop for 17 years and then break out, That is potentially very significant. Now, it's probably retesting that breakout over the last 4 days, 3 days. But I think for non-China EM, there's a lot of positive things going on that's just not really being discussed in the West. Standards of living are rising, not least of which is because China is sending lots of very cheap goods there to improve living standards. The Belt and Road helping that as well. The other big thing I think for non-China EM is the ongoing shift away from dollar-denominated oil and other commodities. Historically, countries could only import oil and other commodities to the extent they had sufficient dollar reserves, because all that was priced in dollars. To the extent we're seeing this shift toward multi-currency energy and commodity pricing, settled in local goods, net settled in gold that floats in all currencies, and we clearly are seeing that, takes the dollar governor, off of growth for a lot of emerging markets out there over time. Now they can't run out of dollars buying oil and other commodities to support their economic growth, their standards of living. They're instead of being governed by how many dollar reserves they have, they are governed by how productive their domestic economy is, because now they can import oil in their own currency. Trading partner OPEC Plus may take their currency, and then that can be recycled into that country's goods. So if you're an unproductive country, it doesn't help you a whole bunch. But if you are a productive country and you make stuff that oil exporters like and need, then all of a sudden you can net settle in your goods settle in your goods, net settle in gold that floats in your currency, and let your currency adjust versus gold over time relative to the OPEC Plus nations. So that ultimately is very growth positive. Non-dollar commodities and oil is very growth positive for EMs around the world. That's not sort of a 3-month trade, 6-month trade. That's a structural, secular thing, years to come. It's gonna move slowly but steadily, I think. And it's something I know my friend Louis Gav has talked about in the past, so that's something that he's talked about. So with that increasing trade with China, with the growing ability to buy commodities in their own currency, I don't think their futures, particularly the non-China EMs, are bleak. I think they're actually pretty good, given that they are creditor nations. They're relatively low debt. A lot of them went through their problems with debt, 25, 30 years ago now, which is making me feel old. So I do think it's probably worth an allocation for some of these non-China EMs, is the point of all that. From TS, why did real GDP growth grow faster when the top tax rate in the US was 70% or higher? In my opinion, there's a couple of factors at least that come to mind. The first was that I understand that deductions were far, far greater. So my dad was an accountant, and I remember seeing, I think it was under Kennedy, and even before Kennedy, the top marginal tax rate coming out of World War II was like 90% in the US. And so I said, 90% tax rates? Gosh, that's terrible. He said, well, you have to understand. You could write off everything. Doctors can write off their Mercedes. They can write off just everything. And so your effective tax rates were often, if not almost all the time, way, way lower than those seemingly draconian top marginal tax rates that you saw in the United States coming out of World War II through, I think, at least the 60s, and maybe even longer. I think a lot of the tax reforms, I think it was under Reagan, but don't quote me on that, like 86, did away with with a lot of those loopholes in terms of those write-offs. So you lowered the tax rate, but you got rid of a lot of deductions, is how I remember it being explained to me by my dad. The second thing is that when the top marginal tax rate was that high in the U.S. After World War II, you have to remember the rest of the world was flat on its back, and particularly the developed world, right? So Europe had just gone through 30 years of war. Japan had been destroyed. Much of Europe was destroyed. China destroyed. Russia destroyed. And so, I mean, it's morbid, but of the people that were alive in 1913, if the number of people in the world that were alive globally in 1913, by the end of 1945, 7% of the number of people alive in 1913 had died during the wars of those 30 years. Most of those in Eurasia. So really it was probably 10, 11% of Eurasia's population died from 1913 to 1945, or 1914 to 45, and their infrastructure was laid to waste. And so point here is that in 1945 through, call it 60, the U.S. had by far the most working age men per capita, by far the most factories per capita. Immigration was very low. And so the real wage growth in the U.S. was very high. Middle class was very strong. And so I think ultimately, basically, we were financing and rebuilding the world after an unprecedented calamity. And so it was pretty easy for U.S. real GDP growth to be really strong. And at the same time, by the way, we were investing in highly productive domestic projects like the Eisenhower Highway System, space race, Cold War, which might not have been as productive, but ultimately translated to productive consumer goods later on. You get the point. So I think that's a huge deal. We didn't have to compete with anybody. And beginning in the 60s, we started to have to, starting with the Germans and the Japanese and so on and so forth. So hopefully that offers at least some context. I don't know that that's a full answer, but I think it's a pretty good partial answer. From M, still think no recession and the impact on Bitcoin. Yeah, I still don't think we're going to have a recession. I think these last 3, 4, or 5 days in the market, I think we just got a little glimpse of how a recession, a nominal recession, not necessarily a real recession, but a nominal recession would have to look. So Japanese banks blow up, nothing is done. They contagion over to either European and U.S. banks. U.S. banks start to suffer due to contagion somehow. As that happens, the Fed then just says, we're just gonna let them all. We're gonna let the chips fall where they may. And oh, by the way, if you have $250,000 in a bank, anything over that, we're not guaranteeing. Have a good day. And then you have bank runs. Making the banks dump treasuries to refund the bank runs. Now rates go up in this recession. It is the worst Great Depression possible. It is the hardest hard landing there is. And so the bottom line is, I would never say there's no hard nominal recession could happen. But I would say that the option is not hard landing of plain vanilla recession. It is catastrophe hard landing, like the plane into the ground at 90-degree angle and 600 miles an hour, or no recession nominally. Those are the two choices here based on the fiscal, debt, etc. setup. So continue to think nominal recession is highly unlikely, not least of which because the deficit is still running at 7% of GDP in the U.S. What does it mean for Bitcoin? I think ultimately it's hugely positive for Bitcoin. Bitcoin, as we all know, is volatile. It's likely to continue to be volatile. And to me, it continues to be the last functioning smoke alarm. So if you don't like the volatility in Bitcoin, you're too big. Get smaller. If it keeps you up at night, you're too big. Get smaller. And that's how you manage it. To me, I think about Bitcoin as a option on the fiscal situation that seems mathematically inevitable, except I don't have to pay a time burn. It doesn't have a time decay. It just has volatility. And I can manage the volatility with position scaling and position sizing. So if you're unlevered, the volatility is what it is. And you're going to get, in my opinion, option-like payoffs on the upside, which we've seen Bitcoin do in compressed periods of time over the past, well, its whole lifetime, really, but without the option time decay. So the trade-off is that volatility, which is just a position sizing issue, and don't use leverage. So those are my thoughts there. And then the final question from G. Oil has not been moving in the direction you predicted for the past 9 months. What's your conviction level now, and are you more aggressively buying? So I've been writing for at least the last 6-7 months. I expected oil to trade between $70 and $90 a barrel in a range. $90 because that's the level the U.S. government could not afford because it would blow up the treasury market or cause treasury market dysfunction, to be more accurate, which we've seen repeatedly, and not below 70 because that's the level below which U.S. shale production would begin to go offline, which then creates a geopolitical problem for the Americans because it begins to seed the oil market on a sustained basis to OPEC and Russia. Simply because once you start shutting shale down, it takes, if you shut it down too much, it takes a long time to bring it back to prior peak levels. For example, shale production peaked in 19. It didn't recover in the United States to 19 levels until 2023, 4 years. So in the meantime, Russia and Saudi have way more leverage in the oil market until you can get that shale back up. So I think the American government wants to keep oil between $70 and $90. So it's been trading there. I feel good about that call. I've also been expecting energy company multiples, PE multiples, to expand as markets came to grasp that oil is going to be kept in a range of $70 to $90. That has not been correct. That is, oil stocks have, I was looking at XOP before I jumped on here. Nothing. It's done nothing. So that has not happened. That has been wrong. I still think that will happen. It's a sector I still like, but it's not a sector I'm hot and bothered and in love with. In terms of just where I'm putting incremental capital. I've been putting more incremental capital into both gold and Bitcoin, which I continue to think are energy-linked neutral reserve asset plays. So it's a little bit of a chicken energy play. There's still that energy link. It's not as direct if energy really rips. But again, I don't think energy's really going to rip. I don't think oil's really going to rip. I think it's going to be range-bound. I think the multiples will expand in oil companies, oil production companies. What I think is going to rip is dollar liquidity to address the fiscal situation, and therefore gold and Bitcoin, I think, will continue to outperform over time. So hopefully that helps clarify the thought process there a bit. In the meantime, we're going to wrap it up for tonight. Thank you for joining me. If you like these updates, check out FFTT-LLC.com for more information about our tree ring product. 10 most interesting things, a brief synopsis about each one, what grabbed our attention, whether it's changing the way we were thinking about the world or reinforcing it. And with that, I am going to sign off. Everybody have a great rest of your night. Look forward to chatting with you soon. Take care, everyone.